Hey everyone, it's Jenny here. Welcome to our first video on financial education. Today's topic is real estate versus stocks. Which one is better? Which one is more profitable? And what actually suits you best? We're going to break everything down in a simple and clear way, and by the end of this short 13-minute video, all your doubts will be cleared. But here's a little twist. Today's voiceover artist is different. She's not just a voice, she's also a financial coach, highly knowledgeable and incredibly well educated. So without wasting any time, let's meet her.
Hello everyone, my name is Lisa, and today we're going to understand real estate versus stock market. Which one is better for you, especially if you're planning to invest but still feeling a little confused? We'll break things down in a simple and practical way so you can make a smarter decision. But before we begin, a quick disclaimer. This video is for educational and informational purposes only. It is not financial advice. We do not recommend or tell you where to invest your money. Every investment decision should be based on your own research, risk tolerance, and financial goals. For more personalized guidance, it's always best to consult a professional financial advisor. Now, with that said, let's get started.
Okay, let's settle this once and for all. It's the ultimate showdown in the world of investing, putting your money in real estate versus putting it in the stock market. You know the drill. Your friend just closed on their first rental property and can't stop talking about cash flow and tenants. Meanwhile, your other friend who's all in on index funds just kind of smiles, knowing their portfolio is quietly doing its thing in the background. This argument is a classic for a reason, but today we're going to cut through all the noise, all the opinions, and the "my uncle got rich doing this" stories. We're going to run the numbers. We're going to follow two identical investors for 20 years and see what the cold, hard math actually says.
Now, that's a pretty bold thing to say, right? It basically suggests that both our real estate mogul in training and our stock market guru have some serious blind spots. And they do. See, one of them is about to find out that passive income isn't always so passive. In fact, sometimes it feels like a second job you're paying to have. And the other? Well, they might underestimate just how hard it is to sit on your hands and do nothing while the market goes on a roller coaster ride. By the end of this, you'll see exactly why both of them are missing a huge piece of the puzzle.
All right, so to really do this right, we need a fair fight. No head starts, no secret advantages. We're setting up a perfect financial experiment. We've got two contenders, standing at the exact same starting line. They've got the same amount of cash, they make the same salary, everything is equal. But from day one, they're going to take two completely different forks in the road to building wealth. Let's meet them.
Okay, on the left, we've got Jake. We'll call him the landlord. He's got 50 grand saved up, he makes 55 grand a year, and he's ready to make a big move. He takes that $50,000 and puts it down on a $250,000 house. This is key. He's using leverage. He's controlling a $250,000 asset with only 50 grand of his own money. Now, on the right, we have Marcus, the index investor. Same exact financial situation. He takes his 50 grand and instead of buying a house, he buys a total stock market index fund. Think of it like buying a tiny, tiny piece of thousands of different companies, from Apple to your local utility company, all in one go. He sets it to automatically reinvest his dividends and plans to add $300 a month every month. No calls to the bank, no keys, no tenants.
And you know, this right here highlights the huge psychological difference between these two paths. From the second he signs the papers, Jake feels like a boss. He has a tangible thing. He can drive by it, he can point and say, "I own that." He's got a great story to tell at parties. "Oh, me? Yeah, I'm a real estate investor now." It sounds impressive, right? Meanwhile, what does Marcus have to show for his big move? An email, a digital receipt buried in his inbox. It's kind of boring. If someone asks him what he invested in, he says VTSAX, and their eyes just glaze over. So on day one, Jake is winning the feeling successful contest by a mile. But as we're quick to find out, feelings don't always translate to your bank account.
So let's dive into Jake's world first. From the outside looking in, being a landlord seems like the ultimate financial hack. You buy a place, someone else lives in it and pays off your loan for you, and you get to keep the change. It sounds like a dream. But we're about to open up Jake's books and look past the shiny surface. We're going to look at the hidden ledger, the place where all the inconvenient and sometimes painful costs of doing business are hiding. And here it is, the number that makes everyone want to become a landlord. This is the simple, beautiful, back-of-the-napkin math. Jake finds a tenant who pays him $1,800 a month in rent. His mortgage payment, that's principal and interest, is about $1,330. You subtract one from the other, and boom, $470 a month. Pure profit, right? A little money machine printing cash for him every single month. This is the number he tells his family, the number he thinks about when he's feeling good about his choice. But here's the spoiler. This number
It's a fantasy. This right here is the million-dollar question for anyone even thinking about getting into real estate. That lovely, clean $470 profit figure is just the tip of a very, very large iceberg, because what's lurking just below the surface is a whole world of expenses and headaches that simple calculation just loves to ignore. So let's pull back the curtain and see what's really going on. And this is where that pretty picture starts to fall apart. First up, property taxes. For a house like Jake's, that's probably about $3,000 a year. So let's take $250 off his monthly profit. Then there's insurance. That's another $1,500 a year or $125 a month. All of a sudden, that $470 in profit is down to just $95. Then there's vacancy. It's optimistic to think you'll have a paying tenant every single day for 20 years. On average, a rental is empty for about a month a year. That's a whole month of paying the full mortgage with zero income. Then there's maintenance. The rule of thumb is to budget 1 to 2% of the property's value every year. Some years it's a small plumbing leak. Other years it's a $5,000 water heater that dies on Christmas Eve. And that's totally separate from the big stuff, the capital expenditures. The roof, the furnace, they have a shelf life. And finally, the two biggest wild cards. You can pay a property manager 8 to 10% of your rent, or you can spend your own weekends and evenings doing it yourself. And the one that can sink your entire investment, a bad tenant. So what happens after you add all that up? After you account for the taxes, the insurance, the month the apartment was empty, the new dishwasher, and setting aside money for that roof you'll need in 10 years, what's left? Well, Jake's actual return on his $50,000 investment, what we call the cash-on-cash return, drops like a rock. It lands somewhere in this range, 3 to 5%. Now look, that's not nothing. But for all the work, all the risk, and all the late-night calls about a clogged toilet, Jake is earning a return that's, well, just okay. It's a far cry from the get-rich-quick story people often imagine. Okay, let's hit pause on Jake's adventure for a minute. While he's been busy screening tenants and calling plumbers, what's been happening with Marcus? Well, Marcus has been doing, nothing. Absolutely nothing. And that's the whole strategy. We're now shifting from the very active, hands-on world of real estate to the quiet, invisible, but ridiculously powerful world of passive investing. It's time to check in on the guy who started with nothing more than a boring email. This right here is Marcus's superpower. It's been called the eighth wonder of the world, and honestly, that's not an exaggeration. It's like a snowball rolling down a hill. At first, it's tiny, and it picks up just a little bit of snow. You barely notice it's growing. But as it gets bigger, it starts picking up more and more snow with every single rotation. In investing, your money earns more money through dividends and price increases. And then that money starts earning its own money. The best part? It requires zero effort from Marcus. No work, no calls, no stress, just time. This really paints the picture of their two different journeys. If you were to chart Jake's net worth, it would be a jagged line. It goes up a little with rent, then takes a nosedive when he has to replace the furnace, then slowly creeps back up. It's a bumpy ride that requires constant attention. But Marcus's chart? It's a smooth, beautiful, exponential curve. For the first 5, maybe even 7 years, it's not that exciting, to be honest. It just kind of plods along. But then, the curve starts to bend upwards. And in the second half of our story, that slow, boring line turns into a rocket ship heading for the moon. All right, enough with the theory. We've seen the strategies, we've talked about the pros and cons. Now it's time for the main event. Let's fast forward the clock, not 1 year, not 5, but 2 full decades. 20 years later, where did Jake's hard work and Marcus's epic patience actually get them? No more what-ifs. Let's look at the final scorecard. So let's follow the money. 3 years in, Jake has managed to pocket a few $1,000s in actual cash after all his expenses. Marcus, thanks to market returns and his steady contributions, has already seen his $50,000 grow to about $76,000. Then, at year 5, Jake gets hit with a big one, a new roof for $8,500. It completely wipes out all the cash he's saved up. Marcus, he just keeps cruising, and his portfolio is now over $135,000. But then something interesting happens around year 10. You'd think Marcus would be way ahead, but they're surprisingly close. Both are sitting on a net worth of around $175,000. Jake's leverage and the fact that his property has gone up in value has kept him right in the race. And then we hit the fast forward button to year 20. And the final tally? It's almost a dead heat. They both end up with a net worth somewhere between $400,000 and $500,000. So wait a minute. They both ended up in basically the same place with close to $500,000? So does that mean the choice doesn't matter, that it was all a wash? No way. Not even close. This is where the story gets really interesting. Because if the destination is the same, then the only thing that matters is the journey. And their journeys, Well, they couldn't have been more different. It's not about the money they made. It's all about how they made it. This chart tells you everything the final net worth number doesn't. Let's break it down. Time. Jake basically signed up for a part-time job that he didn't get paid for 20 years. We're talking hundreds, if not thousands, of hours. Marcus, 0 hours, not one. Leverage. Jake used a massive loan to amplify his results, which is powerful, but also incredibly risky. Marcus used 0 leverage. Diversification. Jake's entire nest egg is tied up in one single building in one single city. If that local market tanks, he's in big trouble. Marcus owns a piece of the entire global economy. Their biggest worries? Jake's nightmares were about tenants and toilets. Marcus's nightmares were about stock market crashes. And finally, liquidity. If Jake needed a big chunk of cash tomorrow, he'd be out of luck. It would take months and cost a fortune to sell. Marcus could have cash in his bank account in about 2 days. And if you want to boil this entire 20-year experiment down to a single sentence, this is it. Jake's path was active. He was a small business owner. He built his wealth with his hands, his time, and his stress. His wealth was a direct result of his labor. Marcus's path was passive. He built his wealth by being disciplined, by automating his savings, and then having the courage to just get out of the way and let time and the markets do all the heavy lifting for him. One is a job, the other is a waiting game. Now hold on, before you decide that the doing nothing approach is obviously better, we need to talk about the huge caveats here, because real estate has some serious superpowers we can't ignore. That leverage we talked about, it's an incredible tool if things go right. The tax advantages, like writing off depreciation, are a massive deal. And every single month, his tenant is forced to pay down his loan, building his equity for him. It's a forced savings account. But the stock market? It has a secret kryptonite, and it's our own human emotion. It's easy to look at a chart of the last 20 years and say, I would have held on. But actually living through a crash, watching your life savings get cut by 30 or 40% in a few weeks, it is terrifying. And most people, they fail that test. They panic. They sell at the very bottom. So Marcus's success isn't just about picking the right fund. It's about having the iron stomach to not screw it up. And that's what this all comes down to. This isn't about which investment is mathematically superior. The math shows they can both get you to the same place. The real question is, which investor are you? So ask yourself honestly, do you like fixing things, solving problems, and being hands-on? Or does the thought of a 2 a.m. phone call about a broken pipe make you want to run for the hills? And on the other side, can you truly honestly watch your nest egg plummet on a screen and not touch it, trusting that it will come back? Or will the fear and panic make you hit the sell button at the worst possible moment? One path demands your time. The other demands your nerve. There's no right answer for everyone, but knowing yourself is the only way to find the right answer for you.